Hello and welcome back to the next video in the FX Evolution trading course. Today we'll be talking about longing and shorting in the Forex and trading markets. Many people are familiar with longing, but I often find that shorting is a relatively new concept to many traders and it can be quite difficult to understand. So let's begin by defining long. To long a currency pair, the first currency pair will be bought while the second currency is sold. If we're looking at an example of this, if we were to long the euro US dollar, we would be buying the euro dollar and selling the US dollar, which would mean that we'd be hoping the euro dollar will increase in value against the US dollar. I think it's always easier to break it down to this one here, where we're hoping for the euro dollar to increase in value against something else, so in this case the US dollar. If we use that same example for short, let's have a look at that. So to short a currency pair, the first currency is sold while the second currency is bought. This will mean that if we're to short the euro US dollar, we'll be selling the euro dollar and buying the US dollar. And again, this is the easiest way to understand it. We'll be hoping the euro dollar will decrease in value against that US dollar. Let's take a look at the term bull market and bear market. So in a bull market, we are mostly looking for opportunities to long. This means we are looking for opportunities where the price will increase over time. In a bear market, we are mostly looking for opportunities to short. So this will mean we're looking for a decrease in value over time. So I often get asked, why the terms bullish and bearish, and why are they synonymous with upward trending and downward trending markets? The term bullish actually comes from the way that a bull defends when it feels threatened or attacked. A bull will charge you and try to fling you up into the air, and this flinging up or pushing up is actually where the term was coined. That's why bulls or bullish markets are now synonymous with upward trending markets. In contrast, a bear, when it feels attacked or threatened, will actually push you to the ground. And what it will do is it'll push you and claw you to the ground. And this action of pushing down is where the term bearish came from. So now that we've discussed bullish and bearish markets, let's take a look at some real-life examples of bullish and bearish markets. We'll also take a look at how we can profit from bullish and bearish markets when trading them. And we'll be breaking it down into a dollar amount. It's important to note that every dollar amount that we're doing from the next available slides will be in US dollars. So depending on the country you're trading in, you may have to account for your currency exchange rate. Here we have an example of the US dollar Canadian dollar in a bullish or upward trend. Let's assume that we chose to long this or buy into the market at a price of 1.3500. If the market continued to go upwards, we could close this trade with a profit. So let's assume that we close this at 1.4. To work out the profit, we can take the 1.4, the greater amount, and minus where we bought in, which is 1.35. This will give us a remainder of 0.0500 of profit, or 500 pips as we like to use in trading lingo. Let's assume that we are longing now a 0.1 mini lot of the US dollar Canadian dollar at the same prices. We long at the price of 1.35 and we buy, to do this, we buy 10,000 US dollars for every 13,500 Canadian dollars. As the market trends up and goes to a price of 1.4, you can see that to close this order, we sell 10,000 US dollars and we get in return 14,000 Canadian dollars. So this will mean that we've profited 500 Canadian dollars. To bring this back to our trading account, which is in US dollars, we'll need to take the 500 Canadian dollars and divide it by the 1.4 US dollars. This will give us a remainder of $357 of US dollars of profit. Let's again look at an example, this time in a bearish market. Here we have the US dollar Japanese yen. If we were looking at shorting or selling the market, let's say at the price of 123 here, and the market moved down in our favor, we could look to close at a profit at some point. Here we've closed at 119. To calculate the profit, we again take the larger number and minus the smaller number. So we take the 123 and minus the 119. This will give us a remainder of 4. Now, as the US yen is over or a larger currency, you'll see that the 4 actually equals 400 pips. Let's again assume that we are shorting this time a 0.1 mini lot of US dollar Japanese yen. We short the trade at 123, and this means that we're selling 10,000 US dollars for every 1.23 million Japanese yen. The trade goes in our favor, and we close at the price of 119, which means that we're effectively buying back $10,336 of US dollars for every 1.23 million Japanese yen. To work out the profit, we take the larger amount and minus the smaller amount, and you can see that by doing this calculation, we end up with $336 of profit from our trade. This concludes the video for today, and we'll see you in the next video.